welcome back. I haven't done one of these videos in a while, but it's going to be a weekly outlook. I noticed that when it comes to overall prices, I am really good at seeing where price is going to go on a long-term basis. And I think when I mess up is when I get too zoomed in. And so when in doubt, zoom out. So let's get into these charts. All right. On the left, as always, we have the S&P 500. These are both daily charts. The right is going to be NASDAQ. I called out that we were going to go to this midway point of swing projection from the high we made in April of 2024 and the low we made in April. I use this distance. I reversed it, threw it in another direction, and it's drawing up there. Now, personally, I think that we've created the high of the summer. I don't think that price is going to go any further than this until later in the year. I'm talking October and forward. Why? Well, we're going to find out really soon. I mean, today or tomorrow. But we made a really predominant high on Thursday, which was a huge displacement candle to the downside. And this happened after, freaking months of upside delivery. Look how many down closed black candles there are in this run up. And then when you get over to this one just stands out. It pops out at you. This isn't random. This is a big displacement candle. That's really, really, really important. This next candle, let's zoom in on ES as well. I want you to notice how ES did not really make that same expansion lower, but NASDAQ did. What does this mean? Okay, we're getting to that. Number one, we have relative equal highs in ES. You might want to take those out. But NASDAQ, I would not like to see a new high. What does that make it? A smart money technique or a smart money tool. And that is an SMT divergence, meaning one index is making a higher high than its sister. We want to see these act as a pair that are in sync. They do the same thing. That failed on Thursday. And we left relative equal highs, which we know love to get rated. The algorithm loves to attack these levels that retail sees as resistance and sends price lower. That's a lie. Don't believe lies. In NASDAQ, I'm seeing this act as an order block. You see how the wick goes past a little bit, but look where the body closes. That's the main focus you need to be looking at. Wicks matter, but not as much as the close of price. And this wick right here is going to be crucial. I'm going to watch the 50% of this range. Let's change it into just quarters, and we just want that 50 level right there at 2640 and a half. So now I'm going to go to 2640 and a half. God is on timing today. You see the increments I could use? It's going by like three and a quarter, 3.5, I don't know, something like that. When I press half, when I press shift, puts it right there. Thank you, God. That is the wick consequent encroachment. Basically is the midpoint between this candle's high and the closing price. I wouldn't like to see price reach deep past this level, if it even reaches it. If it stays beneath it, beautiful. Good. We don't want to see price run up here. This looks like a propulsion block to me. So if we get a closing price beneath this candle's low, that's going to be at 30.32 and a quarter, we will be a lot better off, especially if you want to see lower prices, because then we should see this candle act in terms of order block theory as resistance and send price lower. Now, this is not support and resistance. This isn't supply and demand. This is time and price algorithmic trading and the PD arrays behind them, and how price should respond to these PD arrays, which are signatures in price. Okay? Now, I've been behind the screen for almost 2 years now. And this is the truth. There's nothing better than time and price and getting used to how price should respond to certain PD arrays. If you're able to do that and decipher what price should do based on what it presents to you, then you can tell the future. And if you can tell the future, you can make money with it. That's just the first part. The first part is acquiring the skill. The second part is going to be, can you control yourself? I'm still tinkering that out. I'm 20 years old, filled with fucking testosterone, and I want to take big risks, especially in an account that is simulated. I'll see the opportunity and be like, I know I want to put this much on this trade, when I'm really seeing something I justify. What I really should be trading are 3 things. That's it. And that's going to be the focus going into this week. Model 22. The 2022 ICT mentorship playlist that has a model from it. Very simple. Wait for a daily high or low to be rated. Wait for a shift in market structure that leaves a fair value gap. Once price returns to that fair value gap that creates the shift in market structure, go either short or long depending on the direction that it's going. Boom. Get 20 handles, get out. Make sure your risk management no more than 2%. Boom, you're good. That's it. I described it in less than 30 seconds. And yeah, I deviate outside of these. Why? 1, pride. I think I know better because this is how price should respond. I see, price should respect this fair value gap because it's going to go to this 15-minute fair value gap. Pride. I think I know better than I do because I get it wrong. I get it wrong so often. And I'm not happy about that. And I get it wrong because I deviate outside of the models I know deliver. All right. The other model I should be trading is Model 11. Model 11, let's see if I can describe this in less than 30 seconds, correlates exactly with Model 22. When one index creates Model 22, Model 11 should appear. The only reason it doesn't is if, let's say, NASDAQ has Model 22 going on, and in ES, since it's a lot smaller, it's only $5,000 versus $20,000, the handles and how much it moves might not create a fair value gap when NASDAQ does. And so that same model won't form, but it is the same premise. The only thing it doesn't require is a daily raid on a higher time frame. So that's not needed. As long as Model 22 is there, Model 11, all right, that's the requisite. That's the prerequisite for Model 11 to be traded. Is Model 22 has to be there. And number 3, my last model, the silver bullet. Silver bullet. And if I'm trading anything before 950, it's not a good trade, and it's something I should risk no more than 50% of my account on. 0.50, not 50%. Gosh, I can't believe I just said that. 0.50, 0.5%, maybe even 0.25%. But silver bullet is the prerequisite to models 22 and 11. Why is that? It's because it is the move that is part of the raid on the daily high or low. Okay? And that's it. It's before it happens. This is before Model 22. I mean, the algorithm, it's determining what's going to happen. I mean, you might not think that's true, and that's okay. I know it's true, and I make money off of it. I'm going to make money off of it. I have made money off of it. I'm up about $650. And no, it's not making ends meet, but it's $650 more than what I started with. And now I'm going to limit myself to those 3. That's it. That's all I'm going to trade. 3 models. That's all I need. I don't need to be some crazy lunatic. I just need to make money with it. That's what I'm going to transition it to. I thought I wanted to know everything about the markets, and I still do. Maybe I'll go keep learning from ICT. I'll still trudge through his videos. I might go find even another model, but I'm not going to be some crazy all-knowing market guru, because I'm not. I'm fucking not. And I think in the past I wanted to be. I wanted to be praised and worshipped, and I wanted to be the one that knew it all and had all the answers so I could give it to the world, but I think I just was prideful. I want to be the best. I want to be fucking worshipped. And that's not who I am today. It's not. So, who am I today? Well, I'm glad you asked. I'm Zachariah. And I'm telling you right now, in my honest opinion, we're going to have lower prices this week. So, watch for this candle's low right here from Friday at 23.32 and a quarter, and then the rest of this fair value gap, which is 259 and a half. I'm also going to watch the fair value gap right underneath it. That low of this range is 20.074. I want this whole area shot through like a fucking hot knife through butter. All right, I want this shot through, and I want to get into this sell side inefficiency, and that's going to take time. It might happen this week. It might happen next week. But I don't want to see any respect of these levels like we did for this fair value gap and how we responded onto it on Friday. Okay? And that's it. I will catch you guys on the update, and we will run through what happened, and that's it. Pretty simple stuff. So next time, safe trading and be safe.